If you're anything like me, you probably have been confused about how your portfolio is taxed. Well, today we're going to demystify taxes that are specific to your investments, more about the strategies that can help you minimize those taxes. My name is Luke Turner, co-founder of Moment Private Wealth. We help athletes and entrepreneurs get smarter with their money. So now that you know about the topic for today, you've probably heard the term, don't let the tax tail wag the dog. Well, today what we're going to do is we're going to cover 4 key areas to help you get smarter about portfolio income and taxes. So the 4 areas we're going to cover are: 1, we're going to talk about what are the most tax efficient solutions to actually hold inside of your investment portfolio. The second topic is going to be how do capital gains taxes work. The third is going to be how is your portfolio income taxed. And then lastly, what are the different types of accounts that you can hold these assets in, and what is the different tax consequences of each. So let's go ahead and dive right in. Okay, so first up is investment solutions. What are the different types of investment solutions you can own, and how are they taxed? All right, so first up is how are your investment solutions going to affect your taxes? So when we think about investment solutions, there's typically 2 components to any investment solution. You can either be buying a stock, which is equity in a company, or you can be buying a bond, which is debt in a company. But when we think about those 2 components, there's really 3 ways that you could actually go out and purchase them in the marketplace. You can either go out and buy the individual position. An example of that would be going out and buying Apple stock, ticker APPL, and you go out and buy 1 share of Apple stock. The second would be an exchange traded fund, which is a way for you to buy a conglomerate of stocks all under 1 ticker. An example of that would be the ticker SPY, which is the S&P 500, where if you bought SPY, it would only be 1 ticker in your account, but it would be as if you owned all 500 of the stocks that make up the S&P 500. And then the last is a mutual fund, which is also a conglomerate of individual positions. But what we're going to talk about here in a minute is that although mutual funds and ETFs are similar, one of them is much more tax efficient than the other. So typically what we see is when we're looking at portfolios, we see a lot of folks that own mutual funds. And the reason why we typically see these as a more tax inefficient investment is that it gives up a lot of control around taxes. So the way that a mutual fund works from a taxation perspective is there's 2 ways that you're going to realize taxes. The first is if you actually go out and you sell the mutual fund. So if you own different positions that are in the mutual fund and the mutual fund goes up in value, if you log into your account, you're going to see it as a gain. If you go out and you decide to sell that position, you're going to realize those gains, and you're either going to pay short-term or long-term capital gains, which we'll talk about here in a moment. But the second way that you could also be taxed is when that mutual fund manager is buying and selling throughout the course of the year. When we get to the end of the year, there's what's called capital gain distributions, where typically it's in the month of December, you're going to see a gain actually distributed into your account that's going to come in as cash, and then you're going to be responsible for paying taxes on those dollars. Now, this isn't inherently, a super negative thing, but it is something to be very aware of because it's very hard to control tax planning and control your taxes when that capital gain distribution at the end of the year is completely out of your control. Whereas an ETF, almost 100% of ETFs are not going to pay capital gain distributions, and it's going to put you in a situation where you can much better control your taxes in the future. All right, the next thing you need to know about portfolios and how they're taxed is capital gains. So this term gets thrown around a lot, but we really want to unpack what are the different types of capital gains and how are they actually taxed. So when we hear the word capital gains, what I want you to think about is you're actually selling something in your account or your portfolio. And typically there's 2 types of capital gains that you could be imposed. One would be long-term capital gains, and the second would be short-term capital gains. So in order to know this, all you have to do is look at how long you've held the position for. So long-term capital gains is anything you've held for over a year and 1 day. And then the short-term capital gains is anything that's less than a year and 1 day. When you're looking at your account, that's how you're going to determine if it's a long-term or short-term capital gain. But now let's talk about the important part, which is what is the difference in taxes between long-term and short-term capital gains. Long-term capital gains get preferential tax treatment. If you were to look up the different ways that capital gains are taxed, there are 3 different brackets. There's actually a bracket that's get taxed at 0%. There's a bracket that gets taxed at 15%. And then the highest bracket is at 20%. So again, these are going to be preferential tax rates. Anytime we can get something to be long-term capital gains, that would be ideal. And then the second is the short-term capital gains. So how are short-term capital gains taxed? They're going to get taxed at ordinary income levels. So ordinary income levels are the same as your W-2 wage. They're the same as active income that you're getting from doing different services. And when we think about those tax rates, they are significantly higher. The maximum tax rate today is actually 37%. So that is a difference of 17% that you're potentially paying if you're selling something and creating a short-term capital gain versus a long-term capital gain. Anytime you're making those decisions in the portfolio, you always want to be aware, is it short-term, is it long-term, and then what is my actual tax bracket? So that way there's no surprises come tax season. Okay, so now that we've covered capital gains, let's talk about portfolio income. Again, there's two ways that you can actually make money in a portfolio. There's capital gains, which is when a stock goes up and down in value. And then there's actually income, which is what you get paid for holding a position. So when we think about portfolio income, there's typically two components. There's dividends and there's interest. And we're going to look at both today. The first is going to be dividends. So dividends are what you're going to be getting paid for holding an equity. So for example, if you're holding Walmart stock, they're going to pay a dividend at the end of each period. And they're going to say, this is the profits that we've made inside of the company. Maybe a portion of those they're reinvesting in the organization, but the remainder of those profits are going to be distributed out as dividends. When we think about dividends, there's two ways that they can be taxed. There's either a qualified dividend or there's a non-qualified dividend. In order to determine if something's a qualified dividend or a non-qualified dividend, it all depends on what's called the ex-dividend date and the timing in which you actually bought the stock or potentially sold the stock. We're not going to dive into the details of how to determine when something's actually a qualified stock because it's actually rather complicated. But the important thing to know is that you can control if something's going to be a qualified dividend versus a non-qualified dividend. So it's very important to be aware of when you're buying something, when you're selling something, or the manager of an ETF or mutual fund when they're buying something or when they're selling something. But let's specifically talk about the differences of how these two are taxed. So a qualified dividend is going to get preferential tax treatment, and the maximum tax rate is going to be 20%. It's going to get taxed at the same capital gains tax rates that we had just talked about earlier in this video. And then with non-qualified dividends, they're going to get taxed at ordinary income levels. So again, the maximum tax rate today is going to be 37%. So a difference of 17% depending on when you bought or when you sold that stock as it relates to the ex-dividend date. So again, we're not going to dive into ex-dividend dates, but it is very important to understand that qualified dividends are the types of dividends that you want to be having. And if you're not sure, that's a question you should be asking. So now that we've talked about dividends, let's talk about interest. There are two different types of interest you can be paid. There's going to be taxable interest and there's going to be tax-free interest. And I'm sure you're thinking, well, how do I get tax-free interest? But before we get there, let's first talk about the taxable interest. So interest is going to be something that's going to be paid on bonds that you own. And the way that we're going to determine if something's a taxable interest or it's a tax-free interest is the type of debt you actually own. So taxable interest is going to be paid when you own a corporate bond. Think about if Apple was raising money and they issued a bond and you wanted to go out in the marketplace and you wanted to buy that bond, and Apple is going to pay you 5% interest in order to have that bond be held by Apple. Well, that 5% interest, because it's a corporate bond, is going to get taxed at ordinary income rate. So again, the maximum that can be taxed is at 37%. Anytime you own a corporate bond, that's how the taxation is going to work. Now, let's talk about that tax-free interest that we mentioned earlier. So tax-free interest is always going to be around municipal bonds. So think about the city that you live in and say they're going to build a new road in the city, and they needed to raise money to build that road. Typically, what they're going to do is they're going to issue a bond, and you are going to have the option to put money into that bond, and the city is then going to return you your principal, plus they're going to return you some interest. The interest that you're going to get on municipal bonds is going to be federally tax-free. So again, it's very important to understand what are the different types of bonds that are out there and how are they going to be taxed. Okay, now that we know how your dividends and interest are going to be taxed, let's talk about the different ways that you can hold these investments. So this can be very confusing out in the marketplace. There's all these different ways that you can hold investments. There's IRAs and Roth IRAs and 401ks and 403bs and HSAs and all of these different types of accounts. But today we're really going to break it down very simply into three different buckets. there's a tax-deferred bucket, a tax-free bucket, and a taxable bucket. We're going to talk about the pros and cons of each. So first up is tax-deferred buckets. When we think about tax-deferred buckets, these are going to be accounts like your IRAs and your 401ks. When we think about tax-deferred buckets, the biggest pro to tax-deferred bucket is that typically when you put money into any bucket that's going to defer taxes, you're going to get a tax benefit today. So for example, if you were to put in $10,000 into your 401k and defer those taxes, the government's going to look at your W-2 wages and they're going to say, well, rather than Johnny making $100,000, we're going to take out the $10,000 that he put into his 401k because he's deferring those taxes, and we're only going to make him pay taxes on the $90,000 he made. So $10,000 minus $100,000 minus $10,000 is the $90,000 that you're going to have to pay taxes on. So again, that's the biggest pro to that tax deferred bucket. All of the interest, income, capital gains is going to be deferred as well. But the biggest con in these types of accounts is that when the money comes out, it's all going to be taxed at ordinary income levels. So even if you've held these for long-term capital gains and are trying to get preferential tax treatment, it doesn't matter if they're qualified dividends or non-qualified dividends, everything's going to get taxed at ordinary income levels across the board. So that's the tax deferred bucket. Now let's talk about the tax-free bucket. So the tax-free bucket is going to be made up of accounts like your Roth IRAs, your Roth 401ks, and then potentially your HSAs as well. And the way the tax-free buckets work is the biggest pro is that any dollar you put in there is going to grow tax-free, and you're going to be able to take it out tax-free. So if you put $10,000 into your Roth IRA, it grows to be worth $100,000. When you take out that $100,000, you're going to pay zero taxes on all of the gains. But the biggest con is that when you put money into these tax-free buckets, you're not getting any tax advantage today. So if I put that $10,000 into my Roth IRA, I am not going to get any tax benefit today like I would in the tax deferred bucket. So that's the tax-free bucket. And now the third bucket, which is actually my favorite bucket, is the taxable bucket. So the taxable bucket is your traditional brokerage account. And the reason why I see a lot of value in these taxable investments is that, one, when you're investing correctly from a tax perspective, you can control a lot of the taxes. And we've talked about this in this video, making sure that all the dividends are qualified, making sure that we are not realizing short-term capital gains, making sure that the investments we own are very tax efficient in ETFs versus mutual funds. And the biggest benefit to these taxable accounts is it's going to give you liquidity at any point in time. So typically when we think about those IRAs and those Roth IRAs, one of the biggest downsides is that you typically can't touch those dollars until 59.5. Whereas in these taxable buckets, we're going to be able to sell an asset if we need to. We can take it out. We could use it to put the down payment on a house. We could use it to buy a car, but it's going to give us that ultimate flexibility because of the liquidity that we can have in that taxable investment. So those are the three main buckets to focus on. And again, there's no right or wrong answer, but it certainly is something to always consider. How are my assets actually being held? Now that we talked about the four components, you're probably thinking, what do I do with this information? Well, what I encourage you to do, like anybody, is now that you're educated around it, just look at your portfolio. Make sure that you're having qualified dividends versus non-qualified dividends. Make sure that the gains are long-term gains and not short-term gains. And if you have any questions, feel free to reach out. Hope this video was helpful and you feel better educated around taxes in your portfolio.